Happy Friday, everybody. So today I want to talk about a court case that I found very interesting. I get asked questions all the time. So a lot of times we take some, I wouldn't call them aggressive, a better understanding of what business expenses are, strategies and stances that can result in significant losses in your business. Um, and then I get the question, well, if we're reporting losses all the time, do we uh, have a higher risk of getting in trouble by the IRS? Um, Now, when we talk about this, that is true. So I will say that that is true. There is higher risk. And what happens is there's an actual algorithm at the IRS for sole proprietors and corporations and everything that basically, if you report losses for 5 years straight, there is a red flag thrown up. So it does increase your chance of audit. But if you if you set things up right, you very easily can win that audit. Um, and there's been several court precedents set for that. Because really what it comes down to is the rule is you're required to have a for-profit motive. That's the rule. Meaning you're in business to try to make money. You're not in business to actually try to show losses. Um, and so that can be a fine line. And when you go to court over that, uh, the courts typically look at like 20 different facts to see how many of them you meet to determine if you are trying to operate for profit. Examples. Um, Somebody that's I have a wood shop. I like to work in my wood shop and make furniture or wooden toys or stuff like that. And, I'm no artist or expert by any means, but that's a good pastime that I have. It's a pastime. And one of the issues I've always had with it is I can sit there and make wooden toys and stuff, and eventually I can give it out to kids or grandkids in the future or whatever. But eventually, if I just enjoy working with wood and working with my hands, then eventually I'm going to have a stockpile of wooden toys I can't get rid of. So I'm going to sell them, throw them up on Etsy or I don't even know if Amazon homemade still a thing. Probably is, but there's a couple of or craft fairs or whatever, right? So I could sell them and at least recoup some of my expenses. Now, with that as my fact pattern, that's called a hobby. And when you have a hobby, the revenue is taxed as revenue. It's what we call other income on your 1040. Uh, and then expenses are listed as itemized deductions, and they're limited. And there's a good chance you're not even going to get to take them anyway because it's itemized deductions. And we try to maximize the standard deduction and move itemized deductions into businesses. So, plus the standard deductions much higher than it used to be more than 5 years ago. And so what's going to happen is everything I sell at a craft fair, I'm going to just pay 100% tax on it and not get to take any expenses because it's a hobby. Um, I'm not actually trying to make a profit. I'm just trying to recoup some of my expenses. So that's a hobby. A profit motive is, I'm actually doing this with the intent to make it my sole source of income at some point. That would be more of a traditional for-profit motive. I might have my day job and then I spend 6 hours every night trying to get this wood shop going, and I'm constantly filling orders, and I'm putting a lot of time and effort into it to try to make this business go so I can quit my day job. That's different. And the IRS sees things that way. Uh, and because of that, they've built these algorithms because they're like, well, if somebody's putting a legitimate amount of time into a business, then at some point they should show a profit. and they picked 5 years because statistically speaking, most small businesses, and I don't know the exact percentage. It's been so long since I've looked at the statistics and been in business school, but the majority of small businesses fell in the first 5 years. And so that's why the IRS has picked 5 years. It's statistically proven that you're going to fail in 5 years and close up shop. It's after that 5 year point that you can really start to see a significant amount of growth. And so they pick that. So if you show 5 years of losses and you're still in operation, then it's throwing up a red flag because they think at this point you're obviously not doing enough to actually create a profit. Well, if that's the case, how are you continuing to fund this business? And now it looks more like a tax shelter write-off, and it's probably a hobby to the IRS. But that's not necessarily the case. I have a lot of clients that we have redefined what real business expenses are, same as like how, if you're a fitness coach, what are the expenses for Gold's Gym? Well, let's analyze that and look at that. And just because you're smaller doesn't mean you can't take advantage of those same expenses. And that's kind of what we talk about. That if it's an expense for a Fortune 500 company, it's an expense for you. And that's what we do. So a lot of times that can create losses. And I've had clients that have losses for more than 5 years because of that. But they do have a for-profit motive and they are operating as if they're trying to make a profit. They just have more expenses than they do income. And so let's talk about how we meet some of those things. So really what I'm getting to is I have a court case I want to show you. So I'm going to share screen real fast so you can at least just see the title of it and stuff, and then I'll kind of talk about the details of it. So I just Googled it. This is actually from Deloitte. This website, Tax Notes, it's made by Deloitte. So Deloitte is one of the big four accounting firms. It's an international accounting firm. They audit very large publicly traded companies. So this is a legitimate and maybe I don't know. This is kind of a legitimate article if you care about that kind of stuff. So here's the name of the case. It's Paul C. Wondries and Patricia Wondries, petitioners versus the Commissioner of the Internal Revenue as the respondent. This was in 2003. This was actually last year or so when this case was finally settled. And court cases are awesome because they're public information, so we get to actually read this. So let me kind of give you the facts about this. I'm going to go ahead and quit sharing screen because that's really all I wanted to show is that this is a legitimate case. Okay, so what happened was the Wondries own quite a few, and I might have my facts slightly off. I will throw out that disclaimer, so don't quote me on this. I'm not reading it to you. But they owned a bunch of car dealerships in like Southern California, LA area, if my memory serves me correctly, and making a lot of income. Like we're talking 10 million plus a year. So these guys they're doing very well. Well, he decides at one point in the mid 2000, the 20 teens, that he wants to diversify his portfolio out of car dealerships, and he buys a large cattle ranch in Central California, desert area where land's cheaper. Relatively speaking, California is always expensive, but for LA, downtown LA, significantly cheaper land out in the desert. And he starts running this cattle ranch. Well, the guy has absolutely no experience in running cattle at all. So he ends up hiring somebody with quite a bit of experience to basically be the foreman or manager of this cattle ranch. And this guy is a cattleman. He's done it his whole life. So basically, he is the general manager of the cattle ranch. And cattle, if anybody's ever dealt with farming or cattle or anything, it's very hard to make a profit already. Cattlemen can be very wealthy, but it's all in livestock, land, and buildings, and so you make no cash. But that's pretty much what happened. So they end up showing significant losses for several years. Throws up a red flag for the IRS. Here we have this multimillionaire who's showing a lot of income, and now all of a sudden there's this additional business creating significant losses to lower his taxes. And I don't remember the exact figure, but after, the statute of limitations is 3 years. Now they can go back 7 years if they can really show gross negligence or a few other things, but that's difficult. So they pretty much only audit 3 years at a time if they're going to audit multiple years. And they audit, I think it was 15, 16, and 17. And it was somewhere like after they made corrections, basically they said this is a hobby, you lose all your expenses. And the correction was going to result in somewhere with penalties and interest was going to result somewhere between 500,000 and $1 million of additional taxes due. So yes, of course, this guy fights it all the way to tax court because for the potential to save $1 million in taxes, it's worth hiring a team of attorneys to fight this. So he fights it. They go all the way to tax court, which is why we get to read it. And he wins. But he wins because he does a few very certain things to prove to the court that he is trying to operate for profit, even though he continues to fail at it. And what are those things? So, first thing he did, he's a businessman. He knows nothing about cattle. So he registers his business with the state, having a formal state registration. He separates his finances, so he operates it like its own entity that he just happens to be a shareholder in. Just like if he bought stock in Microsoft, Walmart, Google, whatever, right? We don't commingle, and I talk about this all the time. We don't commingle personal expenses with business expenses. He does that, and he does it very well, and he keeps very good, robust accounting records. Then he hires an expert when he's not the expert. And those were basically the facts that the court ruled on. The IRS was arguing that it was a hobby and he was using it basically as a vacationing spot. Um, he was taking his family out there, he was taking clients out there, and it was a way to have a vacationing spot in Central California that he could just enjoy for his benefit and claim it was a tax write-off. And no, he won. And because the other thing he was able to do is he was able to show that that was not the case. There was a lot of time, he would go out there monthly and he was able to show notes and meeting minutes where he met and they discussed the operations of the cattle ranch. There were times he went out there without his family. Yes, there were times when he took his family, but really what it came down to was he had proper registration, proper separation of finances, proper accounting records, and he had expertise in the field. Whether it was him or the person he hired, doesn't really matter. You're able to show that you have expertise in the field. And so that's really what it came down to. And the case was completely dismissed. He won. He won. The IRS got nothing. And so that's why I wanted to like bring this up because, like I said, I get that question a lot. Well, if I'm continually showing losses, am I going to get audited? Chances are if you continually show a lot of losses, there's a chance you're going to get audited. Now, audits can become expensive in time, but if you're showing, $10,000 to $50,000 in losses year over year, that might be saving you a couple $100,000 in tax over those few years, and it's worth a $5,000 audit to defend that. So just some food for thought is basically what I wanted to do and show that taxpayers win against the IRS all the time, but it comes down to one basic thing: proper documentation. And that's how courts operate: proper documentation. And that will win your case over and over and over again. And the biggest proper documentation is properly kept accounting records. Anyway, I hope this is beneficial. I hope this helps you feel more comfortable about being more aggressive about taking business expenses and a way for you to consider lowering your taxes and being able to feel comfortable about it. Okay. Have a great weekend. Talk to you next week.